Hey, welcome back to the High Podcast. I am your host, Ronald. This is my co-host, Romaine Benjamin. We might have another guest coming through. We'll see. But let's get on with the podcast and start discussing what we're going to be discussing. All right. So let's discuss what this particular podcast is about, which is dealing with, credit and, some benefits of credit. And I mean, how can as investors and how can you go about getting that credit, understanding that credit, and then how can you leverage that credit to help you out in the future? Because I mean, you can use credit in so many different ways, personal or business, but we'll be discussing that in this particular episode. So hopefully everyone get a lot of great value from that. And we can, before that, how are you doing, Romaine? How you been?
Things are pretty good, man. Happy to be here. Look forward to just trying to get better at being an adult.
True facts. Trying to do the same thing. This adulting thing is pretty interesting. That's one of the reasons why before we came on, it's like handling so many different things. Kids, getting ready for kids, putting them to bed, and also trying to do a project and completely lost track of time. Yeah, great, a lot of stuff with adulting for sure.
Yeah.
Cool. So, and as far as me, I'm doing pretty good as well. Got a lot of things on my plate that I'm trying to finish out today, really. But I'm gonna give myself some grace so I can, finish what I need to do, but not really stress out about it.
Yeah, I agree with you, man. Just take one step at a time and focus on what you could do in the future.
Most definitely. Cool. All right. So I kind of want to discuss what was like the first time you heard about credit in your life? What was the first thing? Is because I remember one time it's like, yo, don't get a credit card, don't do it. You shouldn't do that. Boom. And that was the end of it. But it was like
Yeah,
what that was like your first time too?
very similar. Father told me stay away from credit cards. Then that was it. That was the guidance. Stay away from, don't
Oh,
get one. And then occasionally I might hear on the TV a commercial that says, you can get a car. We'll say good credit, bad credit, no problem. I remember hearing that.
yeah, it's like,
Other than that, maybe some credits like at Chuck E. Cheese, like for the games, you put in 4 quarters, you get one credit to play. That's pretty much all I had as my education.
see, yeah, like for me, and it's pretty much like on the same page as that. It's like everyone was like, use money. If you don't have the money, then do that as much as possible. But other times when I did hear people who had credits, like they were in a very bad situation, and it was like, well, like you're using someone else's money, you got to pay that money back. I never really understood the interest part of it until later on in life. Then I was like, wow, that's really bad. So like, yeah, you can have like a 22% or higher interest on an annual basis. And that interest is like compounding. So, and then going into like, minimal payments and stuff, like that's something I also didn't understand until later on. I was like, oh, they're trying to help you out. They're telling you, this is your minimum payment to pay it off. So yeah, the credit card company is great. You can pay it off that amount, just pay the minimum payment, you're good. And yeah, that was my introduction. But yeah, and kind of like when do you actually start feeling like you start to understand credit a little bit more? It's like understanding like the financial transaction pieces of it and the concept of credit and how it can like help you out. Well,
Uh,
before we get into that, but just like when you actually start understanding it.
I would say probably around that I got my first credit card, which was after I left college. I finished undergrad and married. Yeah, I think I was married. And I'm not sure who said this to me, but someone around the time I was maybe 1 or 2 years married, they said, yeah, if you want to be able to buy a house later, you need to have credit history. And not only do you have to have on-time payments, but they said you got to have a average age of credit that's pretty long to show that you're a responsible individual. So that's what inspired us to go ahead and get a credit card. And then I realized all those student loans I took out for undergrad contributed. So that was something that was a lesson too.
Yeah, and that's like, my understanding when I got first introduced and start understanding credit. I actually really didn't understand it. I just actually, what happened when I was in undergrad, got a card like a year later. Like I applied for an application at like Wachovia at the time. I believe it was Wachovia. Maybe it was Wells Fargo. I think they switched over to Wells Fargo and I applied with Wells Fargo. And then yeah, there's like, yeah, you want to open up a credit card? It's like, well, tell me about that. Cause I heard credit cards are bad. And you trying to give it to me as a college student. So tell me more about it. It's like, yeah, you as long as you pay it off every single month, you don't get paid any interest, and you're building your credit. At the time, I was like, well, I don't know what this credit thing really does for me because I don't have no need to buy anything like extravagant. So, and I still have this card today, like for 13 years. And yeah, I'm probably going to it later, but I got my second credit card as of recently. So I only had two cards in my whole entire life now.
You're
But
better than me. I still have that one.
yeah, oh
I
snap.
mean, the only reason the number changed is because of fraud. Someone stole the number, so I had to switch it. But it's the same card. And now, if I were to start a new one, that would, hit my average, from my account. So it's like I kind of wish if I was going to make a new one, I should have got a whole bunch of them at once, so that I don't have to worry about hitting my average lifespan. But now I understand, and you may be getting into this, but if I was going to get a credit card, I'm not afraid of them anymore. I just have to be clear on why I'm getting it.
And yeah, and like we've been talking about credit cards, but like that's not the only credit. Like you said, student loans, mortgages, payday loans, and all those different types of credit lines or credit types. So yeah, it's like I knew, like, for example, for loans, I didn't want to try to get them. When I did get them, I was reading through the terms and stuff. You remember during that time of the previous episode, it was like, you read through the terms, you read through the terms now because of what you went through in college. I was asking all the questions because like during that time I was going through like a very rough patch of like college and like feeding myself and take care of myself. And I was like, yo, I just need this amount of money and that's it. If I don't figure it out after this amount of money, that's when I figured out work study. Then yeah, it's not working. I'm gonna go back home and come back in the fall semester or something like that when my college actually kicks in and start paying for my education again. So yeah, but yeah, I was reading through the loans and like subsidized, unsubsidized. I still don't even know what's the difference to this day. But I remember I chose the particular product that only incurred interest after I graduated, but it was like a small amount. I think the other one was like give you a bigger amount. And I was like, no, I just need this amount of money. I can survive like 3 months with this amount of money. So I chose the one that would only occur interest during that time. And the interest part is like, I can't even remember what the interest was because I only think I paid is like after a couple of months after I graduated, the end point of where I needed to start paying for it, at some point it will start incurring interest. I paid it off before then. It was only like $1,000 bucks. So yeah. But there's always like different loan products that have like different interest rates. And so far, credit cards are definitely one of those highest ones. But yeah, I think you said you use private money lenders. So like are they higher than credit cards sometimes, like as far as rates? Like 20, like more than 22% or more?
Well, first off, I would say that hard money lenders would be generally their rates would be between what you would get for a standard mortgage and a credit card. So they're not as the rates aren't as high typically as a credit card, but they're definitely higher than a mortgage loan. And
Yeah,
part of
yeah.
the reason is mortgage, you're typically using a livable home as the security for the loan, whereas a hard money loan using a hard money lender, which you said private lender, so I may have went on a tangent, but with a hard money lender, you're not really able to give them a security that's actually already valuable. You're giving them a security of a property that you have a plan to make it valuable with some kind of rebuild. But with private lenders, I mean, I've never done a private loan myself. I did see with student loans, there was a difference between loans that had higher qualifications, like through FAFSA and your grades that typically those subsidized loans had a lower interest rate or better terms than the ones that were unsubsidized. So yeah.
Mm. Yeah, I think I probably did say the terminology wrong. So not private lender, but hard lenders. So yeah, I think private lenders are a little bit different. It's like a little bit less than like the credit cards, like you said, but a little bit like higher than like a regular mortgage. Because like
Well,
mortgage,
yeah. I mean, I assume based on the experience that I've heard others have, private lenders can be anything. It depends on what you're lending for, what credit score you have. You know, they may have private lenders may have their own ranges of interest rates that they will lend with, depending on your credit situation and how they vet you. And if it's an unsecured loan, it's probably going to be a higher rate than even a hard money loan. Because if with a private lender, you could just be going to them saying, "Hey, I need 5 grand. I'm not going to tell you why I need it. I just need it. Can you borrow? Can you let me borrow it?"
yeah, yeah, no, exactly. I'm trying to see where I was trying to go with that. I probably lost my train of thought. It's
No, you're fine. I'm resisting the urge to get back into debt payoff, which is something I'm really passionate about.
okay.
Because paying off debt, it's advantageous to kind of line up what your highest interest credit lines are, so that you can kind of be strategic with getting the biggest bang for your buck. But
Oh yeah, we're gonna get there. We're gonna get there for sure. Yeah.
but yeah, on the subject of just credit and how it's useful and all that, then yeah, I'm trying to stick to that as long as you like.
Yeah. And then like the other thing so like car loans too. So I seen people and I heard people having car loans like roughly around like 15%. I don't know how you can get that high. Like I have a car loan right now that's like 5 point something percent. I can refinance it to like 3 something now. But I'm probably gonna do that. But 15% is like crazy high. And I think it's
Well,
like, yeah, what you about to say?
yeah, I mean, it depends on the down payment compared to the value of the car, right? Like
Hmm.
if, for me, I remember I bought an $8,000 car and put I think 4 grand down, like with the help of my dad. It was a 2004 Toyota Corolla and it had like 116,000 miles on it, but it was reliable. It just squeaked a little bit, the serpentine belt, No matter how many times I sprayed it or changed that belt, it still squeaks. I don't know what was up with that. But
Bearings.
maybe.
Hmm.
But yeah, I have seen when I've helped people with their debt payoff plan, I have seen rates commonly around 14, 15%. And it's typically they bought a vehicle and put almost the minimum down that they had to just to secure the car loan. They weren't thinking about how much money they would be losing in interest. They just wanted to have a nice vehicle and they wanted a payment that they could afford monthly.
Exactly. And this all goes into like the terms of things because someone with a 15% like annual interest rate, their terms could be like spread out for a long term. So like 6 years to 7 years or something like that. And depending on like the value of the car, like you said, it's like they try to catch you with that. So they play with the numbers and say, oh, okay, if you put down this amount of money, then we can get you to that payment that you want. They
And
ask
that's
you like,
so dangerous. I hate
oh,
that.
I'm
When
telling you,
when people start off with, okay, so how much do you want your payment to be? Y'all need to go walk out for a little bit, go talk to a friend because no, you don't get something for nothing. They're gonna get their money.
oh yeah.
So when they try to serve you up like, hey, we can make the payment what you like. Nah, bro. You got to figure out what cost. It's like the monkey paw metaphor where you get a wish, but it might cost you your right arm. So
Exactly. Oh my gosh. Yeah, that's a famous phrase that I hear a lot. And they try to get me with that too, but it's like I already know what payment I was gonna have when I came in there and the money I came in with the credit score and all that stuff. It's like I did the research beforehand. And that's something that you might have to typically do. But kind of going to like the next segment of this is like, I mean, why is, credit history, credit scores, like the importance of it. Like, how did it come down to people needing credit scores to be trustworthy? And probably already already pretty much like explain why, but essentially what like the history behind credit scores. And for the most part is about the trustworthiness of a particular borrower. So like it was usually it's like I think it started way back in regards to like a system in regards to people being trusting in a community. So they'll trust them with a credit to get paid back the creditor at some particular point. And it started to develop, and more like systems started to build out, such as now you have your Equifax, you have your Experian, you have TransUnion, all those particular companies that store this data of your history of like credit. And then there's different like factors that play into that as well, such as your payment history, the amount of utilization of your credit, the amount of inquiries of like how many times you try to get more stuff or get more loan products to add to your particular account of credit that you are existing or don't have. And I think it was the last one. I can't history of credit. I think so.
So yeah, there's history, there's credit utilization ratio, there's number of open account, there's the average age of account, and there's on-time payment.
Yeah. And then like the scale ranges from 900 to maybe zero, I think.
I
Yeah.
think it's 300 to 850.
850. Okay. Yeah, you were.
850 is the highest. I forgot what the lowest is, but
Hey, you might be spot on to that. Because from I remember, like you said, 850 sounds right. Pretty much essentially that's a perfect credit score. But people say like you have a perfect credit score if you have over 800.
300 to 850.
Yep. Yeah.
Wow,
And
I'm surprised I remember that.
hey, you own it, man. We got a lot of history in regards to credit.
Yeah.
You and me together. But yeah, so like, essentially, the credit history and your credit scores, like that was a way of defining someone who is trustworthy. And this is like the only way you can like apply for those particular loans or be able to leverage those particular credits, because there's a history of being a trustworthy buyer, someone who's consistently paying back the money that you're given. And it's all about trustworthiness. I remember a couple of people borrowed $5 from me when I was a little kid. When I
And
was
they
in high,
didn't pay you. They didn't pay you back, did they?
they did not pay me back. So I knew
I can
it.
see the anguish on your face, bro. You know where they live. You waiting for them to drop that $5 in your mailbox.
And then I kept on asking. I was like, "What $5? What $5? What do you mean? Oh, I need $5." It's like, okay, yes, you get me once, no more. Fool me twice. Same on me. Yeah, but yeah, so yeah, for an example of that is like trustworthiness back in the day. So like I don't borrow, like nowadays I don't give no one money. I say no to everybody. Grandmas, mom, little kid. Yep, even my little kids, they be smiling all cute and adorable. Like, nope, I gotta see your trustworthiness.
Wow.
What's your credit score in my eyes? That
Wow, you're funny.
Oh man. So yeah. Now like kind of going to like the building credit segment. So like going to this next segment, we started to understand like where this credit comes from and everything. But now like how do we build credit? And we kind of like spoke on some of those points, like establishing good credit and those particular factors, and like tips and strategies. And maybe you can probably like touch on this is like your strategy of like paying back debt, like a high amount of debt, and what's your strategy in regards to that?
Well, I would say paying down debt actually it's counterproductive if you're trying to build your credit score in some ways, because if close an account by paying it off over a period of time, eventually that account will drop off your credit history, which will then make it where your average age count is now shorter. So what I say is, for example, to God be the glory, was able to pay off my student loan. It really helped my credit score to have for old student loans on my credit history. After a number of years, maybe 6, 7 years after they were closed, they all dropped off. like the ones that I paid off, to where my average age of account dropped significantly. Now, the good news is the average age of accounts is not the most significant factor to your credit score. I mean, I would say the two most impactful factors to your credit score are on-time payments and your credit card or your credit card utilization ratio, which is how much credit card balance carry each month compared to how much you can carry, which is the max your credit card will allow you to borrow.
Is
Those two.
is also 1 second. Is also delinquency like a high one? I can't remember that one, but I
So
think.
that I would cover that under on-time payment, because if you're
Mhm.
not on time, then you'll start going to be under collections, which is a huge problem for your credit.
Mhm.
So yeah, so if you're on time, then you're not gonna be under collections and be delinquent for any of your credit lines.
Yeah.
But yeah, so debt payoff, even though it's helpful, I think if you want to be financially free, debt payoff is a goal you should have. In the terms of credit, I could just say be mindful that if it's more advantageous, if you want to increase your credit score, it's more advantageous to keep a credit line open with a low balance than to fully pay it off. For example, like with a credit card, right? You want to maybe make a few purchases each month and then pay off the full balance, so you don't accrue interest owed because there's no balance to put interest on. But because you made purchases with your credit card, the credit card stays active so that your age of your credit history continues to grow. Now with loans, you can't really do that well. I mean, unless you just don't fully pay it off. But with loans, typically there's a minimum payment each month you have to pay. So you can't just like have the balance be there forever. Once you pay it off, it's gonna be closed eventually.
Yeah.
But that's the beauty about having like credit cards that you just never get rid of. It helps your credit score. Now, you could argue once you get to a certain place in your life where you don't intend to make any purchases, that you don't have the money to cover yourself, you could argue at that point you don't need to have a higher credit score because you're not going to borrow. But if you're ever planning on doing some type of entrepreneurial pursuits where you want to borrow for like a business loan or borrow to purchase a home, for example, for real estate or whatever, typically you want to have a higher credit score so that you have that leverage to do that without using up all of your liquid cash that belongs to you.
Yeah, most definitely. And I'd say like some of my tips is, starting off as just with one credit card. And for the longest, I didn't have any credit cards. Is I used Credit Karma when I was much younger, so I was like, tracking that kind of thing. So Credit Karma is like a website and everything. A lot of people might already know them. And then essentially like they break down like those different things that affect your credit score. So like you were saying, like history and everything, they actually tell you different like tips too as well. Shoot, maybe one day Credit Karma will sponsor this podcast. Never know. But yeah, they give you suggestions. Like I don't like their suggestions for credit cards. I don't like, to be honest. Like do your own research on credit cards, but they get some kickback when you click their links. But they do give you suggestions. Maybe for a beginner type credit card, you might choose that if you don't have one, but definitely do research on annual fees, because I don't like fees. But we're probably going to go into this later on, the benefits of credits. But if the annual fee counteract gets wiped out by the benefits and everything, then I'll probably consider annual fees for a credit card. But so far, none of my credit cards have annual fees.
And a lot of bank or credit bureaus will have qualifications to waive their fees. So, for example, I have a credit card that says if I deposit a certain amount or if I have my bank listed as a direct deposit for my paycheck from my job, and that's consistently happening each month, and if I make at least certain number of transactions each month, then I don't get charged a fee. So, even if it's has fees, look into whether or not that credit card or credit line has like qualifications that can make that fee be waived so that you don't have to worry about losing money that way.
Yeah, most definitely. Yeah, exactly. And it's in those terms like that nowadays. Like you said, I read terms now, and that's kind of like why I got the second credit card. It's like I was reading through the terms and the benefits and everything behind it. But yeah, like you can it like within the terms of like their different loan products, you can waive like that fee or lessen it. Call them up and ask them, hey, I've been like a value customer for like a year now. Can you waive this fee? And actually, that reminds me, I probably need to ask my wife to waive her credit card fee on her credit card because we pay that annually. We still use her credit card and everything, but it's like we don't need that annual fee anymore. It's like
Yeah.
it's a reminder every single year to pay that annual fee. But we pay your credit card every single month as well.
And for those who are not like very comfortable or familiar with the topic of credit cards, I know we only spoke briefly on other types of credit lines like loan, car loans, home loans, whether it's mortgage or hard money loans, etc. But credit cards are so prevalent. I think it's worth a disproportionate amount of. But with credit cards, I think it's helpful to remember that it is in a credit bureau's best interest for you to have the most amount of capacity for borrowing. And what I mean by that is a credit entity wants to let you borrow as much as you want to borrow, but they are being governed by laws to say, hey, we can allow you to borrow more than a certain ratio of what you make, your income. So there's this thing called debt to income ratio that financial entities are having to legally not lend to you unless you're under that ratio. I would say ballpark for a lot of entities, that ratio is 43%. So what that means is they can't allow you to borrow more than 43% of what you make each month in income. And that borrowing includes things that you already are paying on as far as debt, whether it's a home loan, or whatever. So everything included, all your credit cards, your bank, you can actually look it up, debt to income ratio, to see all the factors that are in the calculation for your debt to income ratio.
Mm-hmm.
So with that said, if you are consistently using a credit card, paying it off, using a credit card, paying it off, using a credit card, paying it off, you're minimizing how much money you're giving credit entity in the form of interest. But because they use like cash reward, point, all these things as incentive to get people to get credit cards, because credit cards are a great way for banks and credit unions to make money. If you're able to have the discipline of borrowing what you already have the money to pay off, you will build your credit by having the account open. You'll build your credit by having a very low utilization ratio, which how much of a credit balance carry from month to month divided by what you're allowed to use as credit. So you'll build your credit in multiple ways: on-time payments, because you're paying off your credit card on time; credit age, because the longer the credit card is open, it helps that. Your low utilization ratio, because you paid it off, your ratio is amazing. It's like less than 1%, which I think what's considered generally good is like 10% or less. So with all that said, you're going to just be racking up points. You're going to be racking up cash rewards or what have you, because generally, if you look at America specifically, you could Google the average credit balance that people carry, and it's not less than 10%. Like banks and credit unions, they make tons of money off of expecting you to not manage your own finances.
Yep,
So
exactly.
it's free money for you if you're able to have the discipline to say, I'm using this credit card for a purpose. I'm not using it just because it's trendy. I'm not using it because I don't have the money to afford something, which you can, for a season. But it's not a long-term solution. It's a tool to help you reach the goals that you may have financially.
Exactly. So just like you said, it's like, having discipline to use the credit card and everything. And that's one of my tips as well. It's like if you get a credit card, don't use more than 9% is what I say. And then pay it off. Like second thing, pay it off every single month. It's like if you can't pay off 9% of what that credit limit is, then don't use that credit up to that credit limit. Maybe reduce that utilization down to like 5 or even 2%, but make sure you pay off that credit card every single month. If you are paying the minimum balance for maybe 1 or 2 months, make sure you pay it off right away after like the 4th or 3rd month, because you never want to get into this cycle of like continue to be in this debt cycle. And then it's like you said, it's all about the discipline, knowing what money is coming in. Don't be caught into the hype of, racking up your credit card and maxing it out is not a good look, and it's not going to feel good when you're in that particular situation. Yeah, and I was in that situation at one point, but I knew a plan. And like you said, short term, it's not a long term solution type situation when using credit cards. So going to some of the reason you kind of spoken to, like the positive, the positive of having this credit history and everything is going to help out. And there are opportunities in credit cards, and having credit, and not just credit cards in general, but credit itself, and those different different credit types, such as credit card loans, mortgages, car loans, and so on. Like that plays into the culmination of your credit history. And then like those different things, that's also like very important to building your credit too, like having different products. Like when I decided to get a car loan, get another credit card, having a mortgage, it's like the credit card companies were like, yo, shoot that up. He's doing good. He pays on time every single month. He's like, yeah, keep going at it. And I think, the system wants you to be in debt. Like is incentive to like, be in debt. But, if like how to use it and be disciplined to leverage that amount of credit, because it goes into like the benefits of, credit itself and why you should build credit. So like, coming out of college and everything, maybe you didn't know about credit and all this other stuff, but you have been racking up some money in your 20s, and you want to start purchasing a loan. The only thing you've been doing is like racking up your money. But then when it comes to purchasing a loan, you don't got $300,000 to buy a house. So you go apply for a loan. Now, if you haven't, built your credit during that point, the loan people are going to be looking at it as like, hey, we can't give you this loan product. It's too much because we don't know your trustworthiness. But if like Rocky and I, you've been building our credits in our 20s, and you're able to like look at that loan product, and loan lenders are like, okay, you got some history here, so let's take a look, and we can give you this $300,000 loan as long as you put a down payment, and here's are the terms, and you pay it on time during this particular situation. So those big major purchases is a really big financial opportunity. Buying a house, and maybe for your personal reason or even from an investment standpoint, it could be very beneficial. So, we spoke about this earlier in our podcast. Check out a couple of episodes early on. From episode 1 to 3, we spoke a lot about real estate. So yeah, we talked about like, purchasing real estate and how it appreciates over time in the long term. So yeah, discuss like, some things other than, the loans and stuff, like the financial opportunities you have when you're building your credit and you have really good credit, and kind of like what's your standpoint of like the financial opportunities with credit, like a high credit score?
Covered a lot of it. I would say that this world revolves around trying to take the subjectivity out of who you can give something of value. So the credit score, if you're a video gamer like I am, it's like life is an RPG, and the credit score is how strong you are at managing your finances. So if you want someone that has something of value, like a loan of a certain amount you don't have, or a vehicle that you don't want to give them the full amount for, or I know some phone programs, they'll give you the biggest brand new iPhone, and put you on a payment plan that is contingent upon you having a credit score of a certain amount. In this life, the credit score is the most objective way to take emotion out of it and say, hey, I just met you. I have something you want. Show me your credit score. Okay, this tells me that I can give it to you, with a fee of interest, per year. So I would say, everything you covered, plus things like phones, plus more and more, it gives you this sense of freedom, where you don't have to be, it opens up opportunities that are not limited to just how much money you have in your bank.
Yeah, and it was like you kind of like brought up something that sparked up like an ideal, is that with a higher credit score, you get lower rates. You get better terms on your loans. That's a significant savings in a sense that you don't have to be affected by a much higher rate when you don't have to be.
And I and I can
Yeah,
and I
go
can
for it.
guess why. I can guess why because they know if you have a higher credit score, you're not desperate to use their service. So they
Mm,
have to be more competitive now. It's
yeah.
like, oh, you're not, you get to pick and choose which dealership you get this BMW from. Oh, shoot, we got to make sure we like make our loan rate a lot lower so that you
Mm,
choose us. So we at least get something from you instead of nothing.
yeah.
Whereas if your credit score is lower, then they can say, oh well, they're probably gonna have a hard time finding anyone that will give them this car loan. So we can make the interest rate higher so we can take more money for them and take advantage of it.
Mm,
So that's my hypothesis of why the higher your score, the rate is lower, is because they know you have more options available. So they got to fight for your attention.
yo, I never even thought about that, but that makes complete sense down that you mention it like that. Because before I was like, oh, it's higher because you're not trustworthy, trustworthy to hold this loan. But if you're not trustworthy, and it's like, why would they give you a higher credit score than someone who has give you a high, why they would give you a higher interest rate when you have a low credit score, but give someone a low interest rate if they have a high credit score. So yeah, it's like now that what you just explained to like in that hypothesis, which I think that's probably the reason why, is because they know that you can shop around. The financial lingo of like things, and you don't need to stick with their particular product that they're selling. You can shop around and get something way better. And I actually done this myself for my own mortgage rate. I started at like it was like 3.5%, and it was this one. I think it was like the lender was like the builder or whatever. The builder was the lender, but they had like a different separate entity for the building of this house, and it started out 3.5%. So I was like, all right, cool. That's what you're gonna say it was gonna be. All right, let me shop around and go to a different loan product. When I went to that loan product, they said, yeah, we can do 3.0% 3.0 annual APR. It's like, okay, cool. I think I can get something better. So I went back to the lender. There's like, yeah, we can drop this down, but you have to lock this in now. 2.85 or something like that. I can't remember, but it was like 2.8 something. And I was like, yo, I called my cousin in regards to this, and I was like, is 2.8 good? Is that 2.8 interest rate good on a mortgage? She's like, you better lock that in.
She's like, why are you on the phone with me right now? You're supposed to be locking in. Like, call me back. Actually, just leave me on the phone and like do a three-way and lock in real quick.
So,
Yeah, if you Google mortgage rate over the last 40 years, I mean, the 2021, 2020, those rates were extremely outliers. Like the average over 40 years has been 7%, 7.5.
wow.
So, I mean, back then, that's part of the reason why I think houses, we have such a small amount of inventory comparatively. It's because people got houses at rates that you're just talking about, and they don't want to move because they see every house now with the mortgage rates are hovering around 7, and they're
Mm,
like, "So you're telling me I can't afford the house that I'm currently in? Like if I bought the house that I'm in right now again at the same price, I wouldn't be able to afford it because the rate is almost double." Yeah, so we'll
yeah.
see what happens there.
Yeah, it's really really interesting, like you say that, because like I mean, it'll be really unfortunate for someone who has a very low interest rate and they're not able to pay the mortgage, or they got misled in some kind of way and they bought way too much house even for that particular low interest rate for themselves, because that's essentially what they were doing during that time with these low interest rates. It's like, we're going to jack up the prices, or we're going to have them jack up the prices of the market of this house in this particular market, for that housing market. And like I was saying, like way back when I was looking for a house for this one, they were jacking up the prices to 150K and higher, and because people are coming from California and New York and they're selling their properties so they can move here. So it's like, yo, 150K, that's nothing, because in those areas, like evaluations for those houses, that's cheap. Like I'll park my money here, like hopefully nothing happens, but yeah, I'm good with outbidding everyone's coming in. Yeah, so like they're taking full advantage of people during that time and pushing them to get into a house that might be way too much for them because they're saying like people are, saying no, no, like getting rid of like waivers of like inspections. And it's so bad. I feel like that was like the worst time to get a house almost. But at the same time, I found a way around it where I didn't have to bid 150K. I only bid like 5K for this house over and I got accepted. And I was like, boom. And my strategy was to bid on the outskirts where I don't need to be in the city. And I can go to the city whenever I need to, but I don't need to be in the city. Yeah.
Nice, nice.
So yeah. So for me, it's like this lower rate for me, it works for me. The terms work for me, and is way less than what I make. I'm like way below like 20% of like what I make for like paying for rent here, or not really rent, but mortgage here. I don't pay rent no more. I pay a mortgage, but so yeah, it's like, I take that in consideration every time like buying something. Even with the car and everything, it's like 5.6%. I still was looking at the valuation, and all that stuff and see how much it will retain in value. I knew I can refinance later when the rates do come down because like right now they are down. I can't refinance and even get a lower payment, but I'll probably still be paying the same payment that I was at 5.6 because that's just like my mindset. Keep it out there so I can probably pay it off. But maybe I shouldn't do that. Like you were saying, it's like close that account. Then yeah, all the situation. But yeah, we'll see. We'll see about that.
Yeah, I mean, the account age is not the worst thing or the most important thing to be worried about. It's just something to at least be thoughtful of.
Mhm.
There are people who would have like they might get inspired and close like 10 credit cards, not knowing what they'll actually do versus if they just kept them open and just buy a pack of bubble gum every month and pay it off.
Mhm.
It's just something to consider.
Yeah. And the other things in regards to credit for benefits, before we get off on this, is that this is one of the reasons why I got my recent credit card. So it's a credit card that allows you to essentially purchase items, either hotels or, flights and stuff like that. And you get twice the flyer miles. And these flyer miles can be converted into actually trips that you can, pay for airline trips or hotel excursions and entertainment. So
Nice.
it was like, a really nice credit card. Yeah, it's
Yeah.
like really nice. So I was like, yo, I'm already paying for these things already. So let me actually use these things. And also, I already paid my whole entire credit card off. So I'm just getting the full benefits of this credit card because I'm already doing these things already.
Yeah, you just reminded me I need to go check how much cash back I've gotten on my card because I pay pretty much all my bills through our credit card and then just pay it off. So, and I think it's like 2% cash back. So, yeah, just every now and then I'm just like, oh,
Mm-hmm.
there's $600 I need to put back in my account that were
Exactly.
just because I have a credit card.
All because you have a credit card. And then the same thing as well is like the first credit card is like the cash back and stuff. I didn't know anything about the benefits of it until like relatively like 3 years down recently, this past 3 years. I had this credit card for like 13 years. So that's when I started figuring out, oh, you can get cash back with this. And that's why I've been getting this extra, so and so. How can I optimize that? They have like these different rewards to activate on your credit card account. And you can, if you go to like certain businesses that you go on frequent, like you can activate it and get that cash back and even more. So it's
Yeah.
like, it's so much you can do with this credit out here, not just from the housing standpoint. We already spoke about real estate and everything. You can purchase a real estate with a house and then you can stay within that house within 2 years of the first 5 years, sell that house and write off 250K if you're single, 500K if you're married, of the profit of that sale of the house. It's like that's the benefit. Credit cards using it for travel and stuff, like get free flights for buying stuff that you already buy on a daily basis. Booking hotels 5 times X the amount that you on every single dollar that you spend going towards your flying miles to buy flights that you go anywhere. It's a way of saving for money that you don't have to save. Like the credit card is giving to you.
Yeah.
So
Yeah, it's crazy. But it makes sense when you think about how people are being taken advantage of so that companies can afford to give you these benefits.
mm-hmm.
So I hope anybody listening to this feels free to either, learn something that may help them not be taken advantage of, or feel free to ask questions in the comments or what have things that we could help answer or do research if we don't know the answer, to help them not be the one that's paying for these benefits.
Yeah.
Because these companies aren't giving us benefits for free.
Nah, man.
Someone's paying for them. A lot of people are.
See, I didn't even think about it. I was like, yeah, I'm good. I pay my credit card every single month, you know what I'm saying? But yeah, it is unfortunate for people to get sucked into the trap of credit card debt or a loan product that's paying much higher interest. And yeah, it's just like I wouldn't wish that on anyone, especially if they're not like understanding of like the gravity in which they got into and how to get out of it. So yeah, so kind of like sum up like some of the tips and everything. Paying your bills on time in full. Keeping your credit utilization low, and thing that we probably didn't mention up, but monitor your credit reports for accuracy because delinquencies or people or fraud is trying to take your information and use your good name as a way to live off of you, and that you don't want that. You need to report that. You need to say that's not right. And then that's pretty much it. It's like try not to use how, like, even though people say get a credit card for emergencies, it's like if you don't have that money in your bank, don't use that credit card for emergency. Like if it's that bad of a situation, figure another way out. But I wouldn't suggest using credit cards or any kind of loan product or credit as an emergency, because it might come back and bite you in the butt if you're not able to pay it off right away.
I would say it a little bit different. So we do have an episode about saving, and I think one of the tools to be financially free is to have an emergency saving so that you don't have to go to a credit card to bail you out. Now, if you don't have an emergency saving, you have no family or friends that will help you, then yes, you may have to turn to a credit card because you have no other option. But one of the goals of, living below your so that you save for your emergency saving would be so that you never have to go to that credit card, because the credit card is not there to help you. The credit card is a tool to help people that are already on their 2 feet be even further.
Mm-hmm.
The credit cards are not your friend. They're just a tool.
Most definitely. So yeah, I'm gonna close this out. Just recap some of the main points that we discussed in this particular podcast episode. So we went over just an introduction of like credit and the importance in the financial transactions of credit. We understand a little bit more what credit is and why it came about in history and everything. We spoke about building your credit, spoke about the benefits of credit. And then, last, piece is just being responsible with the credit usage and try to avoid those situations, but put yourself in the best situation to for using a credit card and everything. So like you said, remain, usually it's for people who are in a good standing. Hopefully you never have to be in a bad standing with credit, but don't use it like as a last. You should be probably using it as a last resort if you have to. Try to use all those other things to remedy the use of to help you out financially before going to a credit card. But thank you all. As we try to set goals every single time in a podcast. What are some goals that you might be interested in setting before next month for the next episode?
I would like to hear what topic that we haven't covered that you're interested in.
Okay. I feels that. I'm going to continue on with a previous goal. So like continue to market out and continue to improve on the branding of the channel in the podcast, and push out more content out there to probably even bite-size this podcast into small little tidbits of information in shorts or something for you to put it out there so that more wide range of people can get access to this information.
Sounds good. Yeah. Like if you chose like maybe a finance term and like it's like a minute or two max explaining, that's probably gonna be good for some of the low attention span.
Most definitely. Yeah, man. I'm pretty sure, as you see, I lost my train of thought throughout this whole entire podcast.
That's all right.
Yeah, I'm working. But
all right.
yeah, but thank you so much, Romain. Have a good night.
You too. Good night.
Peace.